If you invest, you need to learn the lingo. The investing world is filled with all kinds of complicated words and jargon that nobody ever takes the time to explain. That's exactly what we're going to do in today's episode. We're going to go through 50 investing terms that we think everybody needs to know. My name is Brian Feroldi.
And my name is Brian Stoffel.
Let's kick it off. Number one, 401k. This is an employer-sponsored account that provides workers with a tax advantage waive to save to retirement. With a 401k, you put money into your account before you pay taxes on it. It grows tax-free, and then when you take it out in retirement, that's when you pay taxes on it. Oftentimes with the 401k, you can also get an employer match, which is when your employer puts in extra money to incentivize you to contribute. That can be a great deal.
An acquisition. That's when one company buys another, usually a larger company buying a smaller one.
3, appreciation. That's just when an asset increases in value over the time. For example, if you buy a house for $100,000, later it's worth $120,000. That $20,000 difference is appreciation.
Asset allocation. This just basically means what kind of things are you going to be investing in? Stocks, bonds, real estate. The idea is that you get the right mix to meet your financial goals.
Balance sheet. This is a point-in-time snapshot of what a company owns, its asset, what a company owes, its liabilities, and its equity, which is also called net worth.
A bear market. A bear market is any time where stocks or prices of anything are falling. Some people say it needs to be at least 20%, but in general, the stock market is falling over a prolonged period of time. We would call that a bear market.
Bonds. These are debt securities that are issued by corporations, governments, or other organizations and sold to investors. When these entities want to raise money, one of the ways they can do so is by issuing a bond, and those bonds are bought by the investors.
The opposite of a bear market is a bull market. And a bull market is when the prices in that market are going up. For the stock market, it means that over a longer period of time, the prices of stocks on the stock market are going up.
Capital gains. This is when an asset is sold for a higher price than it was purchased. Going back to the house example, you buy a house for $100K, it raises to $120,000, and then you sell it for $120,000. That $20,000 difference would be a capital gain.
A cash flow statement. This is one of my favorites of the 3 statements every company is required to turn in. And that is a financial statement that gives you a detailed accounting of how cash flows in and out of a company and what is left at the end of paying all the bills.
Compounding. This is when returns from an investment are reinvested back into that investment to generate even more returns. And this can happen again and again and again, taking a small amount of money, turning it into a huge amount of money.
Convertible notes. When companies want to raise money, they have a lot of choices. And convertible notes is kind of a hybrid between taking on debt or issuing more shares. With convertible notes, you're getting money from someone in the form of debt, but that debt can be converted into a stake in the company via shares at a certain point in time and at a certain price. Usually this means existing shareholders will be diluted when they convert. That doesn't necessarily make it a bad thing. It just makes it something to be aware of.
Correction. This is when market prices fall about 10% or more from a recent high.
Debt. Debt is just money that one party lends to another party. And when they do, they have an agreement about how long they have to pay it back and at what rate it will be paid back.
Dilution. This is when a company creates new shares of stock and issues those out, thereby increasing the total amount of shares that exist. When that happens, shareholders that own the stock before the dilution own slightly less of the company than they do after the dilution. So dilution is something that all investors need to watch.
Diversification. This is a risk management strategy where you try and get a mix of several different assets within your portfolio. Now that can be high growth stocks and value stocks and dividend stocks, or you could diversify by asset type, bonds, stocks, real estate, cash, you name it. That's what diversification is. You want to reduce risk while maximizing your potential for reward.
Dividend. This is when a company uses a portion of its profits and pays them out to shareholders.
Related closely to that is the dividend yield. And that's where you take the absolute amount that a company pays out and divide it by the price of the stock at the given time. For instance, if a stock trades for $10 and that same company offers a $1 dividend in a given year, it has a dividend yield or ratio of 10%.
Dollar cost averaging. This is when an investor makes a decision to buy a fixed dollar amount of a financial asset at regular intervals, regardless of the price at the time of purchase. For example, if you contribute to a 401k and you do $100 every pay period, you are dollar cost averaging into your 401k.
The Dow Jones Industrial Average. When the stock market started, it was difficult for people to tell if the economy or the stock market was going up or down. Do you measure all the stocks that are traded? The Dow Jones was taking 30 of the largest companies in the United States and following their stock prices. The idea being that as these 30 stocks move, so does the market.
Earnings per share. This is a financial calculation that's done at the bottom of the income statement. Let's say a company makes $1 million in profit, and it also has 100,000 shares outstanding. Take that $1 million in profit, divide by the 100,000 shares outstanding, and you get $10 in earnings per share. This is a way for all shareholders to figure out how much of a company's profit they are entitled to.
Exchange traded fund, or an ETF. This is just a collection of financial assets, again, like stocks or bonds that can be bought on an exchange just like a stock.
Expense ratio. If you own a mutual fund or an index fund or an exchange traded fund, you often have to pay an ongoing recurring fee to own that fund. That is charged to you by an expense ratio, and it's expressed as a percentage. So if you have a 1% expense ratio, then for every $100 you have invested in an asset, you're going to pay $1 in fees throughout that year.
The Federal Reserve. This is the central bank of the United States, which was created over 100 years ago. The idea being that it could provide a stable monetary and financial system for the economy and the stock market.
Free cash flow. This is the total amount of cash that a company generates from operation minus its capital expenditures or its spending on property, plant, and equipment over a given time period. I want to give a quick shout out to our channel members, 64 and growing as of the time of this taping. Thank you so much. Those channel members got access to badges and emojis, and we recently ran a poll where they get to decide what stock we did from scratch this week. That's why just a few days ago, we recorded DigitalOcean. If you're interested in signing up, check out the main channel and click join.
Gross margin or gross profit. That is when you take all the sales that you had and you subtract out what it costs for you to provide that product or service. What's left is the gross profit. That's a dollar figure. If you want to figure out what the gross margin is, you just take the gross profit and divide it by the revenue, and it tells you what percentage of sales you get to keep after paying for the good or service that you're providing.
Individual retirement arrangement, also sometimes called an individual retirement account. This is a tax advantage retirement account in the United States that is similar to a 401k, but it's not linked to a company. A worker can contribute money to an IRA with pre-tax dollars. Those dollars can then grow tax-free, and you only pay tax on them when you take them out in retirement. They can be a great deal for investors so long as you play by the rules.
An income statement, another one of the big three financial statements that every company needs to provide its investors. This lets you know all of the revenues that a company collected and all of the costs they had to pay to make that business work. And what's left at the bottom are the final profits that are realized, otherwise known as net income.
Index fund. This is a portfolio that has a collection of stocks or bonds that is designed to match the composition and performance of a financial market. For example, the S&P 500 index fund, which is one of the largest index funds in the world, just tracks and owns the exact composition of all of the companies that exist in the S&P 500. Index funds can be a great choice for investors when compared to mutual funds because there's no thinking, there's no manager making decisions, and they are often far lower cost.
An initial public offering is often referred to as an IPO. It's a company's debut on the public stock markets. Prior to an IPO, companies are privately owned and privately traded, but once they become public, anyone can buy shares of the company through their brokerage account. When a company comes public, it is either to allow its early investors to cash out on their investment and also to raise funds by issuing new shares to the public.
Market capitalization. This is the current dollar value of all of the equity that a company has. It's found by taking the current share price and multiplying it by all the shares that are outstanding. This gives you the relative size of a business.
A mutual fund. Brian mentioned them in comparing them to an index fund before. This is an investment vehicle that has a pool of money from several investors. The difference between this and an exchange traded fund or an index fund is that there are money managers that are actively buying or selling different stocks or bonds based on what the goal of that mutual fund is. Sometimes this can work out well, but it's important to note that the expense ratios or the fees you pay to invest in a mutual fund are often higher than you find in ETFs or index funds.
Net income. This is the total amount of profit that a company makes after subtracting out all of the costs necessary to run the business. It's found at the bottom of the income statement. It's also synonymous with profit or earnings.
The NASDAQ Composite Index. This is a stock market index, and all it does is it tracks the price movements of all the companies that are listed on the NASDAQ exchange.
Portfolio. This is just an investor's collection of financial assets.
Ratios. Now, there's a number of different ratios that investors can use to judge the strength of a company or the value of a stock, and we're going to dive into 3 of them to talk about them real quick.
First is the price to earnings ratio, which just takes the total share price of a stock divided by the earnings per share of that stock over the past 12 months. This is one valuation metric that investors can use to get a sense for how expensive or cheap a stock is.
The next I prefer over the PE, which is the price to free cash flow ratio. To figure that out, you take the market capitalization of a stock and you divide it by the amount of free cash flow it has generated over the past 12 months.
Price to sales ratio. This is the market capitalization of a company divided by its sales over the previous 12 months.
Rebalancing. When you start a portfolio, you have the ideal mix of stocks and bonds in it, but sometimes some assets can appreciate faster than others do. And when that happens, you could say that your portfolio becomes unbalanced. That's why some investors prefer to rebalance on a regular schedule, perhaps once every year.
Roth IRA. This is similar to a traditional IRA, but the tax benefits are flipped. You make contributions to a Roth IRA with after-tax dollars. However, once they're in the account, they grow tax-free, and you can take them out in retirement tax-free without paying any penalties, so long as you follow the rules.
A Roth 401k is very similar to the rules that Brian just said. You pay taxes before going in, and it grows and can be withdrawn without paying penalties or taxes, except that it is run through your employer like a regular 401k plan.
The Securities and Exchange Commission, or the SEC. This is the federal agency that oversees America's financial markets.
A sideways market. Sometimes stocks go up. Sometimes they go down, but sometimes for a long period of time they trade within a very narrow range and they don't show gains or losses. We call that a sideways market.
Stock-based compensation. This is when a company uses its own stock or stock options to reward and incentivize their employees. Stock-based compensation is very common among small companies that are growing rapidly because they often don't have the financial resources to pay their employees with cash. Instead of that, they pay them with stock-based compensation. And it's something that investors need to watch because it eventually leads to dilution.
Stock buybacks. This is somewhat the opposite of stock-based compensation. It's when a company repurchases outstanding shares of the company and then retires them. By doing so, the value of each existing share goes up because there are fewer shares outstanding.
The stock market. This is just a place where businesses and investors connect with each other to buy, sell, and trade shares.
A stock split. This is one of the most misunderstood terms that we have on this list, and that's because when a company decides to split its stock, it's taking one of its shares and splitting it into, say, 10 even parts. You might think you have more because you have 10 shares, whereas before you had 1. However, look at the example below, where you might have a share of a company that trades for $540 per share. If there's a 10-for-1 stock split, yes, it's true, you go from owning 1 to 10 shares, but each share is only worth $54, leaving you with the same amount at the end. That being said, sometimes after a stock split, there is a temporary spike in the share price because investors are excited about this possibility, bid up the shares, but over the long run, they really make no difference at all.
Stock market index, also called a stock market indices. This is when a small basket of stocks are used as a sample to represent an entire stock market. We've already talked about 3 of the most popular ones: the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. All of these are used to track the overall performance of a stock market.
Target date retirement funds are one of the newer tools available to investors. The idea is that the mix of assets will change as you get closer to retirement, and you can put your money in one of these vehicles and it will automatically change as you age, going from likely higher risk stocks or assets at the beginning of your career towards lower risk ones as you near retirement.
Well, thank you so much for watching. Was this helpful? Do you want us to do more terms? Please let us know in the comments section below. My name is Brian Feroldi, and my mission is to spread financial wellness.
And my name is Brian Stoffel, and my mission is to publish the rules of finance for anyone to see.
Brian's out.